topic for this video is understanding asset allocation and its importance. Asset allocation means dividing the money into different asset classes to create a diverse portfolio. Now, these asset classes can be equity, debt, cash-like assets, or even real estate. Now, investors decide to allocate certain percentage into this different asset classes based on few factors, which majorly includes time horizon and risk tolerance. Starting with the first major factor, that is time horizon. So time horizon is your total investment duration, which could range from few months to even years, depending on your financial goals. So an investor with a short duration will take less risk to avoid any market fluctuations and even to protect their wealth. While a long-term investor can take risk because they have an extended time to bear any market fluctuations. And the second factor, that is risk tolerance, depends on to what extent an investor is willing to take on risks. So an aggressive investor will be willing to take on more risk to seek higher returns, whereas a conservative investor will take the least risk to protect their capital. As an investor needs to divide its money into different asset classes, let's understand them individually. Broadly, there are three main asset classes. First one is equity. So investing in stocks has high growth potential, but even has a significant risk associated. Second one is bond. So bonds are comparatively less risky and therefore suitable for low risk investors. And the last one is cash equivalents. This includes CD, CP, short-term bonds and money market instruments. They are highly liquid and the safest instruments, but offer the lowest returns of the three. Besides them, other categories include real estate, gold, alternative investments, and so on. So it is important for an investor to perform due diligence before investing because of the risk associated with these categories. Asset allocation is important because it makes sure that the portfolio performs well under any market situation. So what happens is that under different market conditions, one category may perform well while the other category may perform not so well. Therefore, investing in more than one asset class helps you manage an investment risk. At the same time, it helps an investor diversify their portfolio by spreading their money across different asset classes. Asset allocation is also important to help you achieve your financial goals because if you take less risk in your portfolio, you may not generate enough returns, and if you take excessive risk, you may not have enough money when you require it. Therefore, a right asset allocation helps you balance both risk and returns. So after knowing its importance, next is the process of how to allocate these assets. First step is determine your goals. Goals can be for the short or long term, like planning for holidays, buying a car, or saving for the child's education. Your goals will help you decide what type of assets to be considered for investments. So, a short-term investor will opt for less risky assets than an investor with a long-term duration. Second step is to know your risk appetite. So investors have different risk tolerance depending on their age, financial situation, investment duration, and so on. Now the ones having more risk-taking capacity will opt for the riskier assets like equities or alternative investment asset classes to a great extent. Whereas conservative investors who aren't comfortable taking too much risk will choose safe investment avenues. Next is understanding different asset classes. So it is important to understand the characteristics of different asset classes because each has its own risk and rewards. And I've already discussed earlier in this video about the three main asset classes, that is equity, bond and cash equivalents. And the final step is begin allocating assets. So after understanding your financial requirements and different assets, create a mix of asset classes as per your needs. It will help you create a diversified and balanced portfolio. Now, as time passes, investors' goals change. In fact, not only goals, an investment portfolio may move away from its original asset allocation mix. So, let's take an example. Suppose a portfolio comprises of 55% of equity and 45% of debt. Suppose that the market value of stocks grows, whereas bonds remain constant. And because of this, the proportion of equity in the portfolio increases to 60% and debt comes down to 40%. We can see the portfolio has shifted from its original proportions. In that case, the investment portfolio needs to be rebalanced. Rebalancing means adjusting the portfolio as per the changing goals or bringing the portfolio back to its original asset allocation mix. Now coming back, to rebalance this portfolio, sell some of the stocks and buy bonds enough to readjust the portfolio back to 55 and 45% respectively. Alright, then that's about it. Hope the concept was clear. See you with another topic. Thank you.